the S&P 500 just hit a new milestone on Thursday, hitting 5,500 points and making a new all-time high before pulling back slightly on Friday. And the interesting thing is that on Thursday, this was the 31st time the US market made an all-time high in 2024. And it's up currently over 15% year to date. Now, whenever the market makes new all-time highs, people get nervous because they think it's gonna come down. And there's this overwhelming temptation to want to sell and take profits before the market comes down. And increasingly, more and more financial economists and analysts and experts start to come out and they start to scream, bubble, 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 the market's gonna crash, right? They always do that whenever the market reaches an all-time high. But does it mean that all-time highs are a reason to get bearish in the market? Is it a reason to sell your stocks in the market? Or are all-time highs actually less bearish than we think? Well, again, as always, we like to go back to history and learn from history. And what is interesting is that since 1950, this is the S&P 500, from 1950 to the present day 2024. During this period, as you know, the market always goes up in the long run. And over this journey of the market going up to its current level, the S&P 500 has set 1,250 all-time highs since 1950. And that's an average of 16 all-time highs a year. That means in any given year, the market makes 16 all-time highs. And if you break it down by decades, these are the decades, this is the 1950s, 1960s, 1970s, 1980s, right? And if you look at the decades with the most all-time highs, they were actually the most bullish. For example, if you look at 1990s, from 1990 to 1999, the market made 310 all-time highs. And during this decade, which was from right here, 1990 to 1999, the market gained 312%, making 300 all-time highs. The decade with the least all-time highs was the 2000s, which was the year 2000, which was somewhere here, to 2010, which was somewhere around there, right? So during this period, the market only made 13 all-time highs, and it was a bearish decade, if you can see that. So in other words, all-time highs is a bullish signal. It's a signal of market strength, economic strength, and it's not a bearish signal. It's not a reason to sell your stocks. And in fact, this year again, we've had 31 all-time highs, and since the start of the 2020s decade, we've had 104 all-time highs. So far, this has been a very strong bullish decade for stocks. Now, of course, you've got people saying that, well, in 2000 it made an all-time high and it collapsed. Now, why is this any different? Well, there are a couple of reasons why this is very different from 2020, the dot-com crash, and 2008 October, the great financial crisis. If you look at the dot-com bubble, if you're old enough to remember it, and like me, I was in the market at the time, it was a very different market because at the time, stock prices were going up like crazy on companies that were not making money. The companies were not making money. But today, the stocks that are leading the market like NVDA, Microsoft, and Apple, they are making a lot of money. And this chart shows you the big difference. So again, in the dot-com bubble, you can see that this blue line over here is the NASDAQ, the share price of the NASDAQ versus the S&P 500. So the market, the NASDAQ was going up, but the earnings of the company, they were not really making much money. So we call this a bubble. Stock price is going up, is driven by hype and speculation and stories, okay? But it's not backed by actual earnings of the company. And sure enough, companies have to make money. If not, eventually the hype will collapse. That's what happened to ARK ETF. If you look at ARK ETF, a lot of the stocks that they own, the companies don't make money, or they make very little money, and the price was supported by hype back in 2021 before it collapsed, right? But in today's market, you can see that although the stocks have gone up of the NASDAQ companies, the one in light blue, but the earnings of the companies have actually been supporting the share price. And I've said this before, that if you look at NVIDIA, for example, NVIDIA in the last year or so, the share price went up over 200%, but the earnings grew at 600%. And that's why NVIDIA is actually cheaper today than it was a year ago. I said that before, that, when a stock price goes up, it doesn't mean the stock gets more expensive. The stock can actually get cheaper if the price goes up, if the earnings are going up stronger than the price. It's the same thing with the S&P 500. So again, you can see that currently the blue line, S&P 500, is going up and up and up and just hit 5,500 points, but it is actually supported by the earnings per share. And the black line is the forward 12 months earnings per share. So as long as the blue line is close to the black line, there's no bubble. But if the blue line gets far above the black line, then it's overstretched, price is way above the earnings. That's when a bubble forms and the blue line will eventually crash back down to the black line. So as of now, that's not the case. Now the question is, moving forward, do we expect the earnings of companies to continue growing or to contract? Well, as of now, you can see that earnings per share of the S&P 500, this is based on the calendar year 2023, which is already over. 24, this is the current year, and this is next year, 2025, and then 2026. So moving forward to the next 3 years, you can see that analysts have actually been raising the earnings estimates of companies as they benefit from deploying AI. Because with AI, it increases their productivity, reduces their costs, increases their profit margins. So as long as earnings estimates are rising, the stock market can continue to go up. Although I say the S&P remains bullish and will continue to go up over the medium to longer term, does it mean that I'm going to jump in right now to buy more S&P 500 ETF? No, okay, I'm not, and I don't suggest that anyone does it. Why? Because again, the market does not go up in a straight line. The market moves in wave patterns. I've said this many times before. And what I never like to do is I never like to buy during a wave up pattern. I like to always buy on a pullback, on a retracement, on a wave down pattern that will happen once in a while. So you've got to be patient to add on wave downs, then you get in at better prices. So again, as you guys know, you can just look at the wave patterns, right? You've got, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, and right now we are on a wave up pattern. Okay, now again, I like to buy on a wave down. So when will we start waving down? No one knows. Everyone tries to guess. No one can predict the absolute future, but it will wave down eventually. Maybe in July, maybe in August, maybe in September. So usually, as you guys know, August, September tend to be the seasonally weaker months. Is it a guarantee? Of course not, but it's just a guess, right? So don't be surprised that maybe in July, August, September, we get a bit of a wave down, right? If it waves down to this red line over there, the 20 EMA on weekly candles, that could be a level to add if you're looking to average in, dollar cost average in to the S&P 500. Let me kind of like draw a line there, somewhere around there. 5173 could be a level to add shares, right? And you never know, sometimes you could get an even bigger retracement. There will be another potential level of support over there, which was the previous swing low. Let me just get rid of this there, so you can see clearer, right? Previous swing low there, right? And then if we get a much bigger correction, which usually, remember that in a year, the market tends to drop 5% at least 2 to 3 times a year, right, on average. And the market tends to drop 10% at least once a year. When it happens, no one knows, all right? But it will happen. So when, as an investor, I always like to identify key support levels. And these will be the key support levels. First, at the 20 EMA at 5173. Second support level at the previous swing low that coincides with the 40 EMA at 4954. And finally, at the 50 moving average on weekly candles that coincides with the previous swing high. So these are 3 very strong support levels. And again, like I said, as and when the market corrects down, this would be levels where I would add. I would add into the S&P 500 if I was, dollar cost averaging. And these are intelligent levels to add, because you never know, where the bottom is in a correction, right? It could hit this level and then go back up, or this level go back up. So we can never pick the bottom, and that's why it makes sense to always average in our position. Now, here are some people saying to me that, Adam, the S&P 500 is at an all-time high, it's up 15%, but the stocks I own are barely up. In fact, some of them are even down, and my portfolio is not doing too well this year. Now, you are not alone. The reason is this, that so far the gains in the S&P 500 are skewed to just a few companies, bringing up the entire index. So if we take a look at the 10 sectors that make up the index, right? You've got technology, communication services, financials, healthcare, and so on and so forth. And out of all these sectors, are they all going up equally as much? No. You can see that most of the gains are driven by, you guessed it, technology. And not all the technology companies, only some of them, which are the AI-related hardware companies. Those are the ones that are driving all the gains in the market. And there are some technology stocks, for example, like IT consulting, Accenture, or software companies like Salesforce that are barely up this year. In fact, some of them are down this year. And the other one that's up a lot would be communication services, driven by Google and Meta, the two biggest contributors of communication services. Financials are up as well, but only up 8%. Healthcare also up 7%. Consumer defense is up 6.9%. Industrials up 6.4%. Utilities up 5.85%. Energy up 4%. But consumer discretionary, also known as consumer cyclicals, of which I've got quite a bit myself, is only up 3% this year. And basic materials down 1%, and real estate down 5%. So unless your portfolio of stocks are heavily weighted into NVDA or ASML or Apple, those few hardware AI related companies, chances are your portfolio is not that exciting this year. It is probably underperforming the S&P 500. And you know something? It's fine. No matter how great you are as an investor, you can't always beat the S&P in the short term. And I can tell you that even myself, the first 6 months of the year, I'm not beating the S&P 500. I'm not, right? I always beat the S&P over the medium to long run, but short term, there are times when I underperform the S&P. Why? Because although I have Microsoft, I've got Apple, I've got ASML, I've got NVIDIA, I do have all these companies, but I also diversify into other companies. I've got Pepsi, I've got McDonald's, I've got Hershey. So because I'm so diversified, my other sectors, or the stocks that I own in other sectors like consumer discretionary or defensives, they're not up as much. And so my portfolio is not beating the S&P year to date. So, well, let me just show you. This is my returns year to date. Where's that? There we are. Okay. So year to date, the S&P is up 15%. My portfolio is only up 12%. So I'm slightly trailing the S&P 500. And again, reason is because if you take a look at my portfolio allocation, by the way, this is my actual portfolio. I'm not going to reveal all my stocks to you unless you become, unless you're in my private community, then you can see every single position, every single allocation, right? But you can see that technology makes up 31% of my portfolio. So this is the one that's driving my portfolio. All right. Again, not all stocks. I own Salesforce, that's down, but it's my NVIDIA that's up. It's my Microsoft that's up, right? And I've got Viva, which is technology, that's down as well. So I've got quite a number of tech companies that are down this year as well. All right. I've got 24% into consumer discretionary. So I've got a heavy weightage into this. And this has not been outperforming so far this year. As I showed you earlier on, consumer discretionary, also known as consumer cyclicals, that is only up 3% year to date. And that's why that is, in a way, pulling down my portfolio returns. Okay, let's go back to that. And I've got my next biggest chunk would be healthcare. That's up as well, but not as much. I've got financials, 11%, again up as well, not that much. I've got 10% communication, so that is helping me a lot. I own Meta, I own Google, so that's pulling up my portfolio as well. I also own 6% of consumer staples like McDonald's, like Pepsi, like Hershey's, and that's not been up so much this year. Okay, so as an investor, if you are not outperforming the index, does it mean that, oh, you suck, you're a lousy investor? No. I can tell you that in the short term, whether you outperform the index or not in the short term, in a few months or even a year, it's not skill, it's luck. It's completely luck, right? Because it depends on which sectors are in rotation. For example, if you happen to have most of your stocks in technology and AI hardware, of course you beat the market, you do really well, right? Because that sector is what we call in rotation. So different sectors in the market, they take turns going in and out of rotation, right? So when you have a diversified portfolio in different sectors, certain sectors will outperform certain years and certain sectors will underperform certain years. For example, in 2022, it was the complete opposite, right? In 2022, if you held any technology stocks, whoa, that dropped significantly in 2022. But which sector was in rotation in 2022? Energy. If you recall, in 2022, energy did very well. Energy was double digits, right? Whereas technology was minus 20%. Now, of course, we would love to predict exactly which sector will outperform this year, which sector will underperform. But there's no way you can predict. There's no way to know until it happens, all right? But like I said, if in the longer term, in over 1, 3, 5 years, it's not about luck. If you hold great companies, regardless of the sectors, you will beat the S&P 500, right? So for example, just in a 1-year time frame, the S&P is up. Let me just show you. Let's see. Let's bring up Trading View. Okay, let's S&P. So like I said, for year to date, it's up 15%, right? So my portfolio is trailing slightly at 12.25%. But on the 12-month time frame, the S&P is up 24% for the last 12 months. But my portfolio in the last 12 months is up 26%, right? So I am outperforming the S&P in a 1-year time frame, and in a 3-year, 5-year, 10-year, I am way outperforming the S&P 500, right? So like I said, no matter how good you are, you can't beat the market all the time in the short term. But medium to long term, you will always beat the market if you invest in the high quality businesses, regardless of which sectors they're in. Because again, different sectors will take turns going in and out of favor of Mr. Market. But in the long run, great companies, regardless of sectors, will do really, really well. Now, the fact that not all sectors, not all stocks have joined this AI bull run so far this year, is that good news or bad news? Well, I'm the kind of person who always says it's good news. There's always a blessing in disguise. There's always a silver lining. And the silver lining is that even though the market is near all-time highs, there are still certain sectors and certain companies that are undervalued, that are cheap. And as an intelligent investor, instead of chasing those stocks that are running, that are now overpriced, why not look at the ones that are still relatively attractive? So that's my next focus in this video, and I can't cover everything in this video, so I'll do a part 2 where I'll go into more specific companies for you guys to consider. Again, not a recommendation for you guys to buy, but just to think about what kind of companies I look for, and you could also look for your own type of companies that suit your investment criteria, right? So again, the million-dollar question is, what do you do right now with markets near all-time highs? Now, for those of you who are just investing in the ETF, like I mentioned earlier, would I buy the S&P ETF or the QQQ ETF right here and right now? No, I won't. All right. So one of my disciplines, again, is I never buy after a wave up, even though the wave up could still wave up even more. You can never tell when is the exact point when the wave up will end and you wave down. There's no way to predict for certain. There's no way to predict, right? So what I would do if I was, again, just buying the ETF, would be I'll just wait for the wave down, whether it comes in July, comes in August, comes in September. When it comes, then I'll start to dollar cost average and add to my ETF positions when it hits these significant support levels. And that is if I'm buying the ETF. So how about individual companies? So I divide them into two groups. Number one would be those individual companies that are leading the rally this year. They're up double digits and they are overvalued. That's one group, right? Then another group are very good companies, but they have been left out of the rally for whatever reason and they are currently undervalued. So let's talk about the first category, which are great companies, but they are overvalued because they are leading the AI rally. A good example is NVDA. So NVDA currently is my fourth largest position in my portfolio. And for NVIDIA, I hear half the people in my communities getting nervous and saying, it's got up so much, it's got to come down, it's overpriced, and they want to get out. They say, they want to sell, right? Then I've got another group who are saying, it keeps going up and I'm not in the stock. And, should I buy? So I've got half the people wanting to get into NVIDIA, the other half wanting to get out. So what to do, right? So again, never allow emotions to drive your decisions, whether is it FOMO, the fear of missing out, or the fear of losing the profits. So always think logically like the owner of a business. So what am I doing for my NVIDIA position? The answer is I'm not selling. Why am I not selling? Because long run, I expect it to continue to grow and compound. But neither am I buying more right now. Why? Because although I expect it to double in the next 5 to 6 years, because there's a long runway, we're at the start of the AI revolution, but short-term, NVIDIA is slightly overvalued and it is slightly overextended. And so I won't buy until it gets a bit more attractively priced. So again, overextended basically means overbought. As you know, prices move in wave patterns, which I keep saying, right? You've got a wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up. So right now it's on this wave up pattern and it's getting a bit overextended and eventually it's going to wave down. No one knows exactly when. It could be waving down right now. It could be waving down in July, August, September. We don't know, right? So the whole thing is I never like to buy. I never like to so-called chase the girl. I always like to wait for the girl to run into my arms when there's fear in the market, right? So for me, I'm waiting for NVIDIA to retrace at least nearer to this red line, this 20 EMA on weekly candles before I want to add more to my position. Yeah, that's based on the technical perspective. Now, on a fundamental perspective, it's all about valuation. So my recent valuation, and again, bear in mind that valuations change all the time. Every time the company releases its new earnings results, I've got new free cash flow and growth projections, I have to revalue the stock. And NVIDIA is one of the unique companies that every time they announce their new earnings results, I have to revalue it very, very fast. But based on their last report, my intrinsic value for NVIDIA, which I mentioned earlier on, is between $122, my base case valuation, to my more pessimistic valuation of $94. So this is my valuation range. So my discipline as a value investor is to never buy when it's overpriced, no matter how great it is, right? I want to wait for the price to drop below the intrinsic value, which is 122. So it must get below 122 before I would add more to my position. And ideally, not only drop below the intrinsic value, but drop to a significant support level, of which I've identified the closest support where I may start adding more to my already fourth largest position is 101. Okay, and then if it even retraces even more to what's the next level, 87, then of course I'll add even more to my position. So this is an example of a stock that has led this rally. Another example of a stock that has led this rally is of course Apple. Apple is in my portfolio, but it's not a very big position. I wish it was, but it's not because I didn't get a chance to buy enough before it started flying up really, really fast. So in the case of Apple, you can see that my intrinsic value is 166, okay? So, and right now it's 207. So, it's overpriced, So again, Apple, I own Apple. Am I selling it? No, because although short term it is overpriced slightly, it is overextended slightly, but long run, Apple, I believe, would continue to compound and grow my wealth because it's got such a dominant position. But would I buy more Apple now? No, I won't, right? So again, I'll only buy Apple if it gets below my 166 intrinsic value, for example, right? And again, if you take the whale investor course, you will learn how to calculate the intrinsic value for all these kind of companies. And if you want me to do it for you, subscribe to the Ultimate Investors Playbook, where my subscribers, they get my live buy and sell notifications every day. They get my updated intrinsic values, my updated support levels, every single month, my updated portfolio reviews. Now, how about the stocks that have not participated? They've been left out of this AI bull run year to date. For example, in the Dow Jones index that's up this year, but you know what? They've got some components like Cisco down 6%, Intel down 36%. You've got Boeing down 31%, Salesforce down 5.9%, United Health down 8.4%, McDonald's down 12%, Nike down 9.69%. If you look at the NASDAQ over here, right? So the NASDAQ 100 index is up tremendously this year, but look at Adobe's down 9%, Tesla's down 26%. Over here, Lululemon down 38% year to date. So should you buy these unloved stocks that have been forgotten by Mr. Market, or should you stay away from them because something's wrong with them? Well, it depends. Some of these stocks I think are great companies and are just down temporarily for all kinds of stupid reasons, and it's a great opportunity to add these stocks. But on the other hand, there are some stocks that are down a lot this year that I wouldn't touch with a 10-foot pole because I think there are some long-term structural problems with these companies. So how do you tell the difference? Well, I'll cover a lot more in part 2 of this video. If you're interested to watch part 2, be sure to subscribe and click on the notification button so they get notified once the next part of this video is up. Thanks for watching, guys. See you in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.